Good morning and welcome to Killik & Co.'s podcast for Friday 31st of July 2015. First of all, this morning I'm going to talk about some of the macro news from this week and then touch on some of the stocks that have reported during the week. And then finally I'll look at the week ahead in terms of the stocks that are reporting that we cover. First of all, looking at the UK preliminary second quarter GDP was reported at 0.7%. That met market expectations. But what this means is that real GDP per capita has now reached the same level as it was at its peak prior to the financial crisis. One concern, though, is the fact that a lot of the GDP growth is being driven by the services sector, whereas manufacturing and construction sectors have seen little growth in the past quarter. Moving on to the US now. In the US, the data has been mixed on the macro front. Pending home sales and consumer confidence came in below market expectations, while PMI and the manufacturing activity surveys were better than the market had expected. The US also reported second quarter GDP numbers this week, which came in at 2.6%. This was below market expectations. In terms of news around the US Fed, there was unchanged at the latest meeting, and the statement offered little in terms of guidance as to when interest rates will first start being increased. What the Fed did refer to is that they would be looking at what's happening in the labour market and that inflation was moving towards the 2% level over the longer term. If you look at what the market's implying in terms of interest rate rises, at the moment the market's implying an interest rate rise in September with around a 48% probability. That increases to a 77% probability in December. In terms of those market expectations, what we have seen is that over the past month, expectations of a rise in September have been increasing. Moving on to Europe now. Macro data coming out of Europe has generally been quite good. In Germany, the IFO surveys were better than expected, and Euro-wide business, industrial and services confidence indicators were better than expected as well. And looking at Spain, GDP growth in Spain did show an improvement in the second quarter relative to the first quarter, pretty much in line with expectations. Moving on to now some of the stocks that have reported over the past week. First of all, I'd like to mention Amadeus. It reported strong results this week. We like Amadeus. We see it as a very good play on the long-term growth potential in travel, especially driven by higher income levels in emerging markets. Amadeus also offers a play on airlines and other travel industry players outsourcing a lot of their outdated IT infrastructure to players such as Amadeus. We did see a fall in the share price over the past few months after Lufthansa announced special charges for bookings made through GDSs, but we don't believe that this is going to be something that's going to be widespread across industry. And at the time, we said that we thought this was a buying opportunity, and the market has agreed to us with the price now bouncing back up pretty much close to where it was before the Lufthansa announcement. Diageo also reported results this week that were the results for their full financial year 2015. It was a tough year for them, which saw volumes down 1% as there was destocking across their customer base. However, there were some bright spots, especially in emerging markets, Africa, parts of Latin America and Asia. And we do believe that its broad product portfolio and global penetration will allow it to drive growth in volumes and revenues in 2016 and beyond. And we do think it looks attractive currently, offering around a 3% dividend yield. Heidelberg Cement also reported results this week. They were good results, but the share price fell as it announced an acquisition of Italcementi. We do believe that it's a good acquisition from a strategic point of view. There's little overlap between the companies, and it allows it to increase its size in the global cement market. However, we do think the market is worried about the fact that it will be taking on additional debt and that it would potentially lower returns to shareholders. However, we still remain positive on Heidelberg, believing that it can raise cash returns to shareholders over the medium to long term and would continue to be buyers of the stock. Then Baidu, which is China's leading search engine, reported results this week. Revenues were up around 38%, but the stock price actually sold off post the results because EPS was only up 6%. The reason for this is the company is investing a lot in marketing as well as building mobile apps and services that link online and offline business. And the reason why we like Baidu is that we think there is significant growth potential in the Chinese internet market. And you can see here a comparison between the Chinese internet penetration down here and US internet penetration there. And obviously there is still a significant potential for growth as Chinese income rises and more infrastructure is built out in China. Then SolarCity reported this week as well. It's the leading rooftop solar player in the US. And we believe that rooftop solar will be a significant growth area over the next 5 to 10 years. And it'll be driven by a significant fall in the cost per watt of installed systems. And SolarCity has been driving down the costs. You can see since the end of 2012, there's been a 25% reduction in the costs of installation of installed systems, and they're looking still to bring this down another 13% by 2017. And in order to do this, it needs to generate significant scale, and it's investing a lot of money in marketing to build out this scale. Just in terms of why we like solar, I'd just like to show you a quote from the chairman of SolarCity, Elon Musk. And basically, as he says, the sun radiates more energy to the earth in a few hours than the entire human population consumes from all sources in a year, which means that solar panels, together with batteries, are capable of producing several orders of magnitude more electricity that is consumed by the entire of human civilization. So this is the reason why we continue to like solar stocks. Now looking at the week ahead in terms of the stocks that we cover the reporting, in the UK we've got HSBC and eSure on Monday, then on Tuesday Travis Perkins and Walt Disney in the US, and then on Thursday we have Michael Kors reporting. Just in terms of why we like eSure, the stock has been strong this year, it's up 32%, but if you see what's been happening with motor insurance premiums have been falling since pretty much the beginning of 2012. They now, for the first quarter, have started trending back up again. And we believe you'll start to see this coming through in the motor insurers' results. And then finally, Disney will report next week. The reason we like Disney is that it's a fantastic play on content creation and ownership, and they've got an unrivaled track record in terms of developing content through franchise extension as well as merchandising. And we do believe that the opening of the Shanghai Disney next year will open it up to hundreds of millions of new consumers. It's been a very good performer, but we continue to believe that this performance can be continued. That's all for this week. Thanks very much for watching, and we'll see you again next week.